So between 2008 and 2009, over $8 trillion was wiped off the stock market. Companies collapsed, fortunes disappeared, and millions of jobs were lost. A stock market crash can be a terrifying thing. But while most people lose money, there are those special few that are able to make some serious gains. Michael Burry made over $750 million in profits as the market fell in 2008. But how did he and how do others do it? And can you follow the same technique? Well, in today's video, I'm going to run through 3 common ways you can profit from a stock market crash. Hey, I'm Kylie, welcome back to the channel where I break down the tough to understand financial stuff that impacts us all. Before I get started, I have to say this is not financial advice, so by all means, don't take it as such. This is information I've learned as a financial journalist over the years. Short selling is probably the first thing you think of when you hear about somebody profiting from a market crash, mostly thanks to movies like The Big Short and recent events involving GameStop and other heavily shorted stocks. Okay, but what is it and how do you do it? Well, actually, that kind of depends on where you live and how much money you have. So short selling is somewhat frowned upon. After all, you're profiting off a business's misfortune. And if too many people begin to short a stock, it can artificially lower the price and send the market into a panic. So it's a controversial technique, but it can be very effective. Now, there are quite a few different ways to short the market, but in general, shorting a share is basically placing a bet that a specific company or commodity will lower in price over a set period of time. This is usually achieved by borrowing a share, selling it, buying it back at a lower price, and then returning it to the lender. And these are all done through contracts. So for example, Burry bought credit default swaps during the GFC from investment firms like Goldman Sachs. But unless you've got a lot of money or work in the industry, you're unlikely to get access to these kind of deals. Today, some financial brokers and investment funds do offer clients the ability to borrow and short their shares directly, but their services are typically restricted to high net worth investors, like think $500,000 as a minimum. But for everyday people like you or I, there are 2 other main ways to short a share around the world. These are through contracts for difference, CFDs, and options. So contracts for difference are derivatives that let investors bet on the price of a share rising or falling without ever actually owning it. And these are usually leveraged, meaning that your potential profits are higher than traditional share trading, but so too are your potential losses. It's worth mentioning here that CFDs are only available in some countries, like for example, they are illegal in the US after the GFC, but they're mostly legal in countries around Europe, parts of Asia, and Australia. Options trading is similar, and it's also legal and very popular in the United States. Essentially, options trading gives investors the ability to buy or sell a specific number of shares at a specific price on a specific date in the future. And this can translate into profits during a market crash. An easy way to think about this is to imagine entering a contract for selling Afterpay shares. If you purchase a put option at $120 for 2 weeks down the road, and in 2 weeks Afterpay is only worth $90, you can still sell these shares at their original price of $120. Then you can buy the shares back at their lower price, or do whatever else you want. It's your money. So you probably guessed by now that shorting shares is a very risky trading strategy, and it's only advisable to those that are experienced. The biggest risk with shorting shares is that you could theoretically lose an indefinite amount of money. Because you don't actually own the underlying asset, if your bet is wrong, there's no real way to mitigate the damage like you could by simply holding onto a share for a few more years. Plus, when you're buying a share that is going long, if it crashes, you can only lose what you put in. If you short it, the price could rise indefinitely along with your losses. Plus, those of you familiar with GameStop will know the term short squeeze. Basically, a short squeeze occurs when the price of a share rapidly climbs out of the blue. As many investors will have been shorting the stock before the rise, they will very quickly start to bleed money. As more people buy back into the stock to get in on the potential profits, the shorters get squeezed even harder, which is exactly what we saw happen to hedge funds in the US. Okay, but luckily there are other ways you can benefit from a market crash that aren't quite as risky. Buying the dip is one of the most common pieces of advice given to investors experiencing their first market crash. While it's easy to look at a price drop and think about all the money you've lost, the other perspective is to think about the money you can make. And while there are no guarantees, traditionally, well-performing investments will often eventually recover from major recessions. And a large-scale price fall actually presents investors with an opportunity to average down their buying price, and make even more money if the asset's price returns to normal. For example, if you purchased 100 units in VAS, an Australian ETF that tracks top-performing Aussie businesses, just after the COVID crash, it would have cost you $6,147 AUD. Today, those same 100 units would be valued at $9,335. Even if you did have a number of VAS shares that were impacted by the initial price drop, that could have been mitigated by buying the dip. Because most stocks fall during a market crash, it can be a good time to buy blue chip stocks at a discount. For example, Google's share price has risen by about 170% since the 2020 market crash. So if you'd sold during that time, you would have lost out on those amazing gains as the market recovered. This demonstrates a common strategy of mitigating a market crash's impact simply by holding on. Panic selling is a common but damaging response to a market downturn and often results in far greater losses than if you just weathered the storm by holding on. In crypto circles, this is commonly referred to as hodling, or holding on for dear life. But for a variety of reasons, this may not be a viable or preferred option. So there are other strategies you can use to profit off a market crash. That brings me to my final point. Those looking to profit from an impending market crash might consider using inverse ETFs. Inverse ETFs are pretty much exactly what they sound like, an index fund that makes money when their underlying assets go down in price. And these work by buying and selling short futures contracts for their underlying assets. Inverse ETFs and bear funds are considered a safer alternative to directly shorting the market. For starters, experienced professionals are managing the contracts for you, and the amount of money you can lose is proportionately less. These types of funds are still risky though, especially if the market suddenly goes up. Like for example, during the 2020 market crash, I invested in an inverse ETF and wasn't fast enough to sell when the market quickly reversed. And as a result, I lost money off that. So these types of ETFs require much more active trading than relatively passive alternatives like long-term ETFs or market index ETFs. So in conclusion, attempting to profit off a market crash can be pretty risky business. It's really recommended that inexperienced traders stick to holding or attempting to buy the dip. But if you're confident in your abilities and you have the capital to do so, shorting the market can be a very lucrative endeavor. Given the prominence of online brokerage services, pretty much anyone over 18 can buy CFDs or short options to profit from a market downswing, depending on where you live and what the restrictions are there. It's worth remembering that the strategies and specific methods that can be implemented go far beyond what has been mentioned in this video. So ensure that you do your research and become an expert on shorting stocks before you give it a try yourself. And always remember, never invest more than you can lose, especially when you're shorting stocks or any other type of asset. That's it from me today. Don't forget to hit the like and subscribe button if you like this video. And if you're keen on any more videos like this, let me know in the description below. That's it from me. Thanks, guys.